Hey, this is Brett Bonecutter with Monarch Capital on Friday, May 30th, 2014, with an end of the week mortgage rate update. What you see here is a bond chart. If you've watched this before, you know that every vertical line represents a day. And as the lines go up, rates go down and vice versa because bond pricing yield move inversely. So it's counterintuitive to what you might think, but basically what you see is this is a 3-month snapshot, and this basically tells the story of good news. Rates have been more or less drifting lower since really mid-March. I mean, we've had a few waves here, as you would experience in sort of any market, but generally speaking, rates have been coming down, and this week was particularly good. We've been at some new bond highs, or rate lows this week, depending on how you want to talk about it. Today wasn't quite as good, although I think technically that's a good thing. You never want to see a line just going in a direction, all at once, because that starts to become more and more risky. So the fact that it's dropped off a bit today is not a bad thing. And if you want to look at how that translates to actual mortgage rates, this kind of tells the story. 30-year fixed rates on a perfect scenario, where you're going to pay some closing costs and so forth, is low 4s. We're still not quite in the 3s yet, but we're on the brink, and you can see the other rates here as stated. So things are good. The classic question is, where are we headed? Let's look at this max chart here of just the past couple of years, and you can see that again, when we were at the lows last summer and so forth, and then in September last fall, rates were kind of hitting some highs. We've retraced literally a little bit more than halfway. And so, that's the story. Where are we going to go? I don't know. This is kind of a look at today, so you can kind of get a picture of that. But this is my feel for it. Guys, look at, here we see on May 8th, we closed at 102.38, and on May 12th, we closed at 101.63. Okay, so about a 70 basis point drop. What does that mean? It means that your loan within 2 days got almost a point more expensive within a 2-day range, and the rate probably changed anywhere from 1/8 to 1/4. So in my opinion here, over the next week or so, that's about the risk volatility range that we could experience. Now, we've seen epic drops that are much bigger than that. But again, it's really about risk management. I think there's an argument to be had here that rates can go lower because the economy's been soft, inflation appears to be weak, people are starting to think that the Fed, is probably not going to raise rates in this environment. So that's all good news for rates. But you got to remember that we've been on here almost a 2.5-month tear, and markets do have a way of moving in waves and correcting. So what you really have to ask yourself is not which way are rates going, as much as how much risk are you willing to take. Because if it goes your way, you might benefit anywhere from a point in cost to 1/4 in rate. And if it goes against you, it could be 1/4 more expensive to a point more expensive in cost to you. If you have questions about that, let us know. But I think that's really where we're at, and that kind of gives you an idea of where the market sits. If you have any questions, love to talk to you. Have a great weekend. Bye-bye.